Ladies and gentlemen, good day and welcome to the Q1 FY24-25 earnings conference call of PNB Housing Finance Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Deepika Gupta Padhi, Head of Investor Relations and Treasury. Thank you, and over to you, ma'am.
Thank you, Steve. Good evening and welcome, everyone. We are here to discuss PNB Housing Finance Q1 FY25 performance, which you must have seen in the presentation and press release shared with the Indian stock exchanges and is also available on our website. With me, we have the entire management team across verticals, led by Mr. Girish Kousgi, our MD and CEO. We'll begin this call with the performance update by the team, followed by an interactive Q&A session. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual development and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 38 of the investor presentation. With that, I'll now hand over to Mr. Girish Kousgi. Over to you, sir.
Good evening to all the investors. We had a very good quarter one at FY25. Just to talk about some of the key performance metrics. On disbursements, retail disbursements grew by 19% YOY in quarter one. We disbursed retail loans of rupees 4,363 crores. 33% of retail disbursements were made in emerging and affordable segment. Our guidance in emerging and affordable this year on disbursements are 40 to 42%. So we have covered 33% in quarter one. So this will increase and we'll be able to reach our guidance of about 40 to 42% of incremental disbursements, which would come in from emerging and affordable. Our total disbursements grew by 19.3%, retail disbursements by 19%, and within retail, in line with our strategy, we wanted to grow our affordable and emerging much faster than prime. This is more by design. On a YOY, affordable business grew by 157% on disbursements. Emerging grew by 18% and prime by 8%. Talking about the book, we achieved double-digit growth of 14.4% YOY in retail loan asset. And now the book is 65,157 crores. This is the retail book as of 30th June. So if you look at last year, last June, our book growth was 11.5%. We are at 14.4%. Our guidance on book growth is 17%, so we will be able to reach 17% by this year end. The total loan assets stood at 66,986 crores. We have made significant progress in retail book with 97.3% of our book being retail now as compared to 87% in March 2022. Within the retail segment, in order to balance between growth and profitability, we are moving down the affordability pyramid with increased focus on emerging markets and affordable segment. We started new verticals, namely affordable and emerging markets. Affordable was started last year, and emerging market we started this year. We have set affordable segment in Jan 2023, and in 18 months' time, we are able to achieve book of 2,000 crores, and the book stands at 2,361 crores as of June 2025. This vertical has contributed 13% of retail disbursements in quarter one. We started emerging market segment with dedicated branches. We have 50 branches in emerging. So this was started this year in this quarter. This segment focuses on high-yielding customer base with average ticket size of 25 lakhs. Yield on incremental disbursement in quarter one FY25 generated by this emerging market segment was 25 bps higher than the prime segment. We are pan-India present with strong network of 303 branches across 20 states. as on 30th June 2024. With this large presence, we are ready to capitalize the opportunity available both in affordable and emerging segments, predominantly focusing on Tier 2 and Tier 3 cities. We plan to add 40 to 50 branches annually. Looking to grow at 17% of retail loan assets in FY25 and onwards with higher growth in affordable and emerging segments. On asset quality, we witnessed remarkable improvement in the asset quality. Our gross NPA reduced by 241 bps YOY to 1.35% as on 30th June 24. We continue to work towards achieving 1% NPA by this year end. Our overall collections remain strong, and in Q1, we've had considerable recoveries from written off accounts, contributing to reversal in credit cost to -7 bps. During the quarter, in corporate book, we resolved one NPA account and one written off account. The written off account was sold to ARC. During the quarter, we recovered around 80 crores from total written off pool, both corporate and retail. We expect to continue recovery from written off pool every quarter. The company has a written off pool of around 1250 crores in corporate and 500 crores in retail. On the borrowing mix, our cost of borrowing has reduced 6 bps sequentially to 7.92% in Q1. Our ability to borrow from debt market at competitive rates, coupled with improved pricing from banks, aided in cost reduction. The incremental cost of borrowing for the quarter is at 7.75% compared to 7.93% in Q4 FY24. Deposits grew by 7% YOY with 88% as public deposits. CRISIL upgraded the rating to AA plus from AA. Outlook stable. With this, company is rated AA plus from all the 4 rating agencies. In Q1, PAT stood at 433 crores, registering a growth of 25% YOY. Maintained net interest margin of 3.65 during the quarter. We had guided threshold of 3.5% NIM, so we'll be able to maintain that. Our efforts across parameters aided in improving the profitability. Our return on assets improved to 2.38% in Q1 from 2.47% in Q1 of FY24. Return on equity was at 11.4%. Couple of days back, government presented its union budget. The expansion of PMAY scheme to 3 crore houses in urban and rural areas is a significant step towards housing for all vision. With our expanding network of 303 branches, including 160 for affordable and 50 for emerging market segments, we are well positioned to cater to this segment. Under the CLS scheme, up to date, the company has sanctioned to over 65,000 customers with a sanction amount of 13,000 crores. So even though in the budget a high-level disclosure was made, we are expecting scheme details in next 3 to 4 weeks' time. And based on the interactions what we've had with the Ministry of Finance and NHB, we expect the scheme is going to be really beneficial to companies focusing on emerging markets and affordable. So it will be a huge plus for companies focusing on these 2 segments, and we are geared up. So all our branches, all 303 branches will be geared up to do PMAY scheme, which is to be announced by Ministry of Housing Affairs in the next few weeks' time. So it's a huge opportunity. So typically what happens is that we do not know the color of the scheme, but I think broadly it's going to benefit the end customers either by way of a lump sum amount in terms of subsidy amount, or it could be some kind of interest. But we do not know. It is our assumption. It is going to be big and beneficial. And like last couple of term, the scheme was announced. There's going to be a lending cap with a certain margin. We expect the margin to increase this time, so which would aid companies, where the margin was lower than this. For example, today we are talking about NIM of 3.65%. The expected PMAY scheme the margin could be better than this. In the sense, it's going to help PNB Housing. All the 303 branches are going to focus on PMAY schemes, and it is going to help the margin going forward.
Would like to now request Vinay to talk about our financial performance.
Hi, good evening, everyone. Thank you for joining us today. I am pleased to present the financial highlights for Q1 FY24-25. As MD sir mentioned, our PAT has grown 25% year-on-year and remained flattish quarter-on-quarter to 433 crores in Q1 FY25. Net interest income has grown 3% quarter-on-quarter to 651 crores in Q1. Yield for the quarter was 10.03% versus 10.08% in the previous quarter. The marginal drop was due to few repricing and runoff of high-yielding book. At the same time, cost of borrowing has improved from 7.98% in previous quarter to 7.92%. Further, post-rating upgrade, our incremental cost of borrowing at the end of Q1 has come down to 7.75% versus 7.93% in Q4 FY24. NIM during Q1 has more stable at 3.65%. We might face NIM pressure in the short term, but however, with the higher mix of business to emerging and affordable, we should see NIM improvement after few quarters. Gross margin, including fees and other income, has grown by 11% year-on-year to 4.03% versus 3.91% in Q1 FY24. Operating expenses in Q1 have grown 27% year-on-year to 190 crores. This is largely due to branch expansion done in Roshni and emerging vertical during Q4, where we have added 100 branches. This will help in profitable growth going forward. Our OPEX also includes our impact of annual performance appraisals done for FY24. Credit cost remains benign at 7 bips of release in Q1. We have fully resolved one corporate NPA account through settlement during the quarter. Further, we have recovered 80 crores from written off pool during Q1. This has helped in controlling credit costs for the quarter, and we expect the recoveries to continue in the subsequent quarters as well. ROA, which was 2.07 for Q1, is now at 2.38% for Q1 FY25. ROE is 11.4%. Our capital adequacy at the end of Q1 is 29.5%, with Tier 1 at 28.4%. Thank you.
So with this, now I would like to invite and request Dilip to talk about the performance of our retail, prime and emerging business.
Thank you, Deepika. Good evening, everybody. The business that I am going to be speaking about is our retail prime business, which now stands bifurcated into prime and emerging markets. On this side of the business, our loan book registered a growth of 11% and our disbursements registered a growth of 10% YOY. In line with our organizational imperatives, the margin accretive business, which is emerging markets, grew at a faster pace. The loan book in the emerging markets grew at 18%. The disbursements in the emerging markets also grew at 18%. On the prime markets, the loan book grew by 10%, the disbursements grew by 8%. We now have 50 branches which stand categorized as emerging markets. They contributed to 22% of the disbursements in the first quarter of FY25. This will actually go up to 30+% by the end of the year. In the emerging markets, just to give you a deeper color of this business, this portfolio now stands at almost 12,000 crores, about 11,970 crores as of June end. It forms 18+% of our retail loan assets. By the end of the year, we are hopeful that this will be anywhere between 22 to 25%. In this side of the business, our ticket size is actually lesser than what we see on the prime markets. It's in the range of 24 to 25 lakhs. The origination LTVs are at 66% in case of home loans. It is the sourcing here is largely done through in-house channels. Almost 2/3 of the sourcing in these markets is done by our in-house channel. The balance is done through third party or DSAs. On incremental yields in the quarter, overall our yields increased by about 8 basis points on a quarter-on-quarter basis. Again, the lift in yields were higher in the emerging markets where it was to the range of 12 bits. In case of prime markets, it was in the range of 7 bits. We opened about 33 new branches in Q4 of last financial year. We are happy to share that almost all of them have now started contributing to disbursements. In fact, in the first quarter, they contributed to 6% of the overall disbursements. And since they've just started, we expect this percentage to be much higher in the quarters to come. So to summarize, the two imperatives for this business, which is growth and margin accretive growth, we are happy with the progress being made on both of them. On account of the investments in our footprint expansion and technology, growth will go up in the quarters to come. On account of the margin accretive businesses growing at a faster pace, the margins also will go up in this business. Thank you.
Would request Anuja to talk about our Roshni affordable business, please.
Good evening, everyone. Continuing our promising growth story on the affordable housing business side, I am happy to announce that we have become profitable on a standalone basis in our affordable housing business. And continuing to the growth story, we crossed 2,000 crore of loan book in May 24. The loan book stands at upwards of 2,300 crore at the end of Q1, which is 5x growth from same time last year and 32% up from quarter 4 of last financial year. Disbursements grew by 157% on year-on-year basis, and we disbursed close to 600 crore of loans in the last quarter. Overall, on the yield side, again, there is a positive trend that we are witnessing. Continuing our focus on the informal income side, we have developed our expertise on the underwriting side of managing the informal income customer profile, and it is resulting into higher yields for our business. Our self-employed sourcing has also been consistently increasing. Till last quarter it was about 37% of our sourcing. Now it is upwards of 41% of our sourcing. One of the important initiatives that we undertook in the last quarter was implementation of a new loan originations platform, which is a Salesforce-based platform which has been introduced in our affordable housing business. Like most of the other things, we have done a good job in execution of this project, and 135 out of 160 branches are now live on the affordable housing side on the new loan originations platform. And in the coming couple of months, we will be stabilizing the new system, and we are likely to start getting the productivity benefits through the wing-to-wing digitization of the customer application life cycle process. Going forward, one important point that I would want to share is out of 160 branches that we have in our Roshni business, 60 branches were opened in the last quarter of last financial year, and happy to share that we have operationalized these branches in the last quarter, and now these branches that we have opened in tier 3 and tier 4 locations have started contributing more towards our business volume, and this will also start translating into higher yields that we expect from this business in the coming months. Thank you.
Would request Jatul to talk about credit and collections, please.
Yeah, good evening, everyone. On credit front, during the quarter 1 of 25, the total retail logins were 36,151 and sanctions were 24,589 applications, thereby registering a growth of 33% on logins and 26% on sanction count vis-a-vis quarter 1 of the previous year. Decentralized underwriting approach has been adopted by the company, with underwriters being positioned at branches for better business support and control perspective. More than 80% of the loan applications during the quarter had a CIBIL score of 700 and above. On collections front, FY25 kicked off with continued growth focus and momentum of three key aspects: legal actions or measures to resolve delinquency and reduction in NPAs, greater success in property possessions and subsequent auctions, and recoveries from technically resolved pools. This thereby allowed us to have an upbeat performance in Q1, defeating the cyclical industry trend and some amount of operational delays caused due to general elections, vacation of courts in June. To provide detail on this, our ongoing rigor on legal collections saw us successfully possessing over 165 properties in the first quarter. In terms of disposal of repossessed properties, we successfully sold off 98 properties in the quarter through auction channel, recovering complete principal outstanding in these accounts without incurring any loss. The sale count is more than one-third of the total successful auctions done in the previous financial year. Another positive development was the quarterly recovery from technically written off pool. Close to 28 crores in retail were collected from the technically written off pool, which is more than 40% of our total recoveries in the last financial year. So the company is poised to recover from the technically written off pool quarter on quarter. The organization will continue its multi-pronged strategy to bring in further reduction in NPAs in coming quarters, adopting all-rounded approach and reduction in delinquency. Thank you.
Would request Anubhav to talk about our tech transformation, please.
Thank you, Deepika. Good evening, everyone. PNB Housing Finance initiated a massive technology transformation program over a year back. As we stand today, I'm happy to share that most of the initiatives as part of the transformation have been initiated and completed. I would like to cover some of these in brief. Firstly, we have launched a new cloud-based CRM platform, Salesforce platform, which is being leveraged for acquisition as well as improving the customer service capabilities. A lot of automation has been built into this platform, and almost 18% of service requests are being addressed through a self-service mechanism. Using this platform, our inbound agent productivity has also seen an uplift of almost 5 to 10% on a regular basis, despite growing volumes. This platform is tightly coupled with the predictive dialer, which helps to improve the customer outbound capabilities and reduce leakages to a large extent. Secondly, we have revamped our corporate website and converted it into an engagement channel for customers with massive personalization capabilities. And it also provides better access and experience on mobile, which accounts for almost 75% of our user traffic. The new website provides seamless access to our products and services, which has yielded to an increase of lead generation by almost 50% in an organic manner. Thirdly, we have launched a digital collection platform, which provides on-the-go availability of customer data, loan details, payment capabilities, and interaction details to our entire field collection team, and that is yielding to improvement of collection efficiency on a large scale. We have also implemented a new cloud-based LOS system on Salesforce as a platform. With the launch of this platform, which is currently underway and shall be completed by end of Q2 or beginning of Q3 in the current financial year. But whatever branches have been launched on the new platform, we have seen improvement in loan tag processing times, as well as enabling better performance and tracking capability for all functions. Through the digitization of LOS processes, we have seen a reduction in the physical documents that are handled and significant reduction of the manual data entry that is required to be done. Lastly, we have also introduced chatbots which are intelligent enough to act as a channel of customer service. We are calling it RRA. These are introduced on our new website as well as on WhatsApp. And we have seen a significant usage of these channels by the customers for customer service capability in a self-service manner.
Yeah, thank you. So with these updates, Steve, I would request to open up for the Q&A, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Renish from ICICI Bank. Please go ahead.
Yeah, hi sir. Congrats on a good set of numbers. So
Thank
just
you.
two questions from my side. One on the spread or maybe NIM as well. Right. So incremental cost of borrowing is lower than the blended cost of borrowing. We are growing, let's say, incrementally faster in the high-yielding segments. So despite that, why we see NIM, let's say, NIM will be under pressure in near term?
So the reason is, we have couple of reasons. One is the corporate book is degrowing. So we will very shortly start corporate business. So hopefully in next 3 to 4 months time we will start corporate business. So I think now the team is ready. We are ready with the blueprint. Very shortly we will start. So why there is contraction in the yield because of the corporate book rundown. I think that will get solved in next 3 to 4 months time because we start doing fresh corporate business. Number one. Number two. We have a large prime book. Certain amount of BT, even though we have set up a retention team, the BT as a percentage has come down drastically over last 1.5 years time. So there is some BT outs, where that would impact us on the book and eventually on the income. Third, there is also repricing. So on one side there is yield contraction because of corporate book going down. BT out and foreclosure and repricing. On the other hand, we are moving towards high yielding segments. In quarter one, typically, we saw most of the disbursements were a spill off from quarter four sanctions, which were at a lower rate. And which is why in quarter one, we don't see spike in yield. But if you see the current trend, I think there is an improving trend both in affordable and emerging on the yield side. Incremental yield is going up. So you will see quarter two, the yields are going to be slightly higher. As a policy, we had guided margin of 3.5% and we stick to that. I think we will have maybe 3 to 5, maybe 3.5 to 3.665 for next 2 to 3 quarters time. And then the NIM will start inching up.
No, sir, but again, if we look at the corporate book, as on June 24, that book is, hardly anything. So I don't think so there should be any drag because of the corporate book on the yield side. Maybe you are right that incrementally because of the BT out pressure on the prime segment, the repricing, to retain the customers would be lower. Is that the fair understanding?
It is combination of all the three which I mentioned. One is corporate book degrowth. Second is BT out. Third is repricing and foreclosure. All as a combination, I think there is a contraction of yield to a certain extent. And on the other side, we are moving segments and trying to increase the yield, but that is on an incremental basis. So in about 2 quarters time, I think we'll reach to a point where there won't be any contraction of yield and it will start moving up. And that's when we will see the margins inching up.
Got it. And my next question is to Girish actually. So, sir, given we are present in, almost all the customer segments, whether it is prime, affordable, and if the PMAY scheme has to move things faster at the ground, as and when the fine print comes, do you foresee upside risk to our growth guidance of 17% in retail book?
Actually, PMAY is going to help us on bettering our growth rate.
Okay, so would you like to revise our guidance of 17% now, or maybe you would want to wait till?
We would not want to revise for the simple reason if we had to grow at the same yield, we could have definitely done far better than 17%. Since we have a dual task, one is to grow, because last year with so many challenges, we grew at 14.1% on retail. And this year we've said we're going to grow at 17% on book. So this PMAY, we are yet to see how the scheme will get rolled out. And we believe that it will open up huge potential, not only on the affordable side, even on emerging and prime, because if you have to go by, the last couple of times the scheme parameters, I think a lot of customers would qualify even on the prime and emerging side. So we feel opportunity of all the branches catering to this particular segment, whereas affordable would focus purely on affordable. and which would also consider part of PMAY, but otherwise on the emerging and prime side, largely income based, we will have an opportunity. So we would not want to revise the guidance at this point in time, but we are very sure and confident of reaching 17% book growth, what we have guided for.
Got it. And so just lastly, you did mention about this, the margin improvement on the NHB borrowing side. So could you please elaborate a bit on that?
So if you look at the scheme which was there till about March 2022, so the funding which comes from NHB, especially for affordable segment, which is under the CLSS subsidy, so there that funding would come at a lower cost. So one, the borrowing cost, it will help us in the borrowing cost, and number two, there is the lending cap. So the discussion was to increase that lending cap. So that would definitely help us to improve our margins.
It was 5.5%, right, sir, last time?
No, I think the rate kept on changing over a period of time, but however, the margin was fixed at about 3.5%. I think this time there are some talks. I think this is purely our assumption and expectation. We feel that this 3.5% could go up, maybe to 4 or 4.5%, so which is going to help us on all the three segments, be it Roshni, emerging and prime, because our margin on the emerging and prime is less than 4 or 4.5%. So any incremental business we do from this PMAY scheme is going to be will lead to increment in margin.
Got it, sir. Okay, sir. Thank you and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Abhijit Debrewal from Motilal Oswal. Please go ahead.
Yeah, good evening, everyone, and thank you for taking my question. First of all, congratulations on a good quarter. So first thing I wanted to understand is, this fair practices code for lenders charging of interest in this circular that came out from RBI on 29th April. How have we handled this circular? Basically, this circular talked about recognizing interest income only after a DD or check was handed over to the customer. So, the disbursements and the loan advances that we are showing today and the recognition of interest income, is there any component of interest income reversal in our interest income that we have reported?
So we are fully compliant. I think there were a couple of other reasons. One was, I think there were elections during quarter one and also heat wave. I think despite the regulation, what you mentioned, despite election quarter and heat wave, we were able to show growth of 19% on disbursements and book growth of 14.4. I think, else we would have probably been 2-3% higher.
So, I think my question was around, recognition of interest income after that 29th April circular, which talked about recognizing interest income only after a check or a DD was handed over to a customer.
So we had a very strong process even in the past. So the alignment required was very less for us. The gap was very less for us to cover. So in terms of interest loss, it is hardly about 4.5 crores.
Got it. Great. So the second thing was on OPEX. When Vinay sir was giving his opening remarks, he spoke about OPEX also including the impact of annual performance appraisals which were done for FY24. So, was this just in the nature of, increments that happened or also the variable payouts? Just trying to understand how the quarterly run rate is going to be now for the next couple of quarters.
Yeah, Abhijit, this was largely the annual increments. Variable payouts in any case is provisioned, so there is no such impact on that.
Got it. So basically now, is this the new kind of a steady state that we can keep building on for OPEX?
That's right. This is a new steady state number.
And sir, Vinay sir, just one related question. I mean, while you covered liabilities in a greater detail, just trying to understand after this credit rating upgrade, I mean, how are conversations progressing? I mean, incremental cost of borrowings already down to 775. How are you looking at cost of borrowing trending going ahead?
Same, Abhijit. So in this quarter itself, we have seen improvement. It has gone down by around 6 basis points, and the incremental cost of borrowing has come down to 7.75. While it is still volatile, it will still move slightly, but some more benefit is expected to come in the few quarters. And once the PMAY is announced, as sir mentioned, there could be few further benefits which can come on account of PMAY.
Got it. But this PMAY is going to help us more on the growth side as well as on the spread or margin side, because we are expecting the spread cap, which was earlier 3.5%, to be increased when the details of the scheme come out.
It is going to help us on 3 counts. One is on the cost of borrowing, second on the growth, third on the margin.
Got it. And Girish, last question for you. I mean, obviously this quarter there was benefit from recoveries on the corporate side. During the opening remarks, I also heard that out of the total pool of or total recoveries of 80 crores from the return of pool, almost around 23 crores were recovered from retail, if I heard you right. So just trying to understand going forward, while you spoke about a pool of both corporate and retail, return of pool, how are you looking at basically credit cost trending? They are expected to remain benign for the next couple of quarters at least?
I think, credit cost will be muted. Just to give you some numbers, for quarter one, retail recovery was 28 crores and corporate was 53 crores, total 81 crores. And quarter one being cyclical, I think the write back amount was quite low. I think this number will only improve in the quarters to come, both on retail and corporate.
Got it, sir. And sir, later during the call, if you could just explain this corporate account that we have resolved during using customer settlement, what was the nature of that and what was the outstanding and how much have we recovered?
So we had sold 2 ARC, so it was cash and SR. So we recovered the cash portion in quarter one, and the rest would be the SRs will be redeemed in this year. So this is on this particular account. And on the retail, I think it is quite regular in nature, so we'll keep recovering. And we had one NPA in corporate. I think that is now resolved. Now on corporate, NPA is 0.
Got it, sir. Great. Thank you so much and all the very best.
Thank you.
Thank you. The next question is from the line of Subranshu Mishra from Phillip Capital. Please go ahead.
Hi, good evening. Thanks for the opportunity. Shubhanshu here. So, Girish, 2 questions. The first one is around the PMAY scheme. My fair understanding is that if this scheme has to be implemented at scale, as far as self-construction, it can be implemented. However, if the builders have to repivot their inventory, it will take a longer period of time because that supply itself has come off. I just wanted your thoughts on that. How long will the developers take to pivot their inventory for affordable housing? And when do we get that benefit in terms of fructification of disbursements at scale? While I understand for self-construction houses, this could have immediate benefit. The second is around the ARC sale. How much of provisions are we carrying on the SRs right now on the ARC sale? Thanks.
So on the ARC sale, the one that we have done during the quarter, it's 100% provided. And for the other one, we are carrying around 70% provision.
On the PMAY, I think we are yet to get the details. It is still not announced, but we feel that it's going to be a big one. And if you look at the composition of products, under PMAY in terms of whether it is self-construction, whether it is self-construction, plot purchase and construction, depending on the nature of product. I think the opportunity is going to be huge. I think once we get the scheme details, we'll be able to rework on that, and if need be, then we will be ready to take that opportunity forward.
So will we change our disbursement AUM growth guidance once we get the fine print?
No, we will not be able to comment on it. As of now, we stick to 17% book growth guidance. And if there is any need during the year, we may look at revising it. But at this point in time, 17% is where we stand.
17% is the book growth guidance. What is the
book
disbursement?
Growth, yeah. Retail book growth at 17%.
And what is the disbursement growth guidance for retail?
That will be about 25+%.
Sure. Thank you. Those are my questions.
Thank you.
Thank you. The next question is from the line of Viral Shah from IIFL Capital. Please go ahead.
Yeah, hi. Thank you and congrats on good set of numbers. Actually, I have a few questions. Girish, if you can help me understand. So, first of all, in your affordable book, right, what is the share of disbursements that are done for either a purchase or a construction to the borrower versus what is a business transfer?
Sorry, could you please repeat the question?
So, in the affordable segment, the disbursements that you do, what would be the share of the business, the BT ins that you would have got?
Yeah, I think on the BT in would be close to 25%, and BT out is negligible.
Okay. So 25% of the disbursements for 1Q that you have done, right?
Yeah, 25% of disbursement is BT in.
Got it. Next is on the affordable side. I remember in the analyst meet also you had mentioned that incrementally we are looking at a different customer mix and product mix, which is going to ensure that the yields are going to go up by 100 basis points immediately from next year. So from when should we see that? Because I see that the disbursement yields are flat QOQ.
No, so I mentioned that, so it has already started. So only thing is, in quarter one, most of the disbursements were from the sanctions which happened in quarter four. So you will see a very marginal spike in quarter one. It has already started. So you will see yields improving incremental disbursements quarter on quarter.
Okay, so we should see that at least on reported first decimal numbers from next quarter only.
No, this is on incremental. So from let's say from now onwards till this year end. So this year, what we're going to originate, that would carry a yield of 12.6% on affordable.
Okay, got it. And if I have to basically look a bit deeper in your cost of funds reduction of 6 basis points in this quarter, what further room do we have in terms of reduction, given that, again, what was the share of the mix change in this quarter? Because there was some increase in the CPs as well. So is this entire reduction just because of the credit rating upgrade, or there is some more benefit yet to come through because of that?
See, it is combination of various things. So one is, you mentioned CP. Definitely, yes, CP is one instrument. And second is the cost of deposit. For us, it is coming down. While we are growing our deposit book, our cost of deposits is coming down. Number three, we are renegotiating with all the bankers on the existing lines, and all the new lines we are able to get slightly at a better rate. I think it is combination of all these things is resulting in slight reduction in the cost of borrowing, both incrementally and on book.
Okay. And lastly, in terms of the recovery pipeline, last time around you had mentioned that on an average around 50 crores every quarter for 6 to 8 quarters. So that gave us a pool of say around 300 to 400 odd crores. Now that we have had 80 crores of recovery in this quarter, do you see the overall pool increasing, or how the remainder of the recovery pool, how will it look like for next few quarters?
On the retail return of book, we had told approximately about 170 to 180 crores we'll be able to recover this year. So if you look at quarter one, the amount was 28 crores. I think in next 3 quarters we'll be able to cover up another maybe 150 to 160 crores. On the corporate, whatever book we have, that is 1250 crores, that will span out in next 3 years.
Sorry, next?
3 years.
Okay, next 3 years. And lastly, if we just go back to the NIM space in the near term, Vinay mentioned there may be some moderation. What is the extent of it that we are talking about? Is it just 5-6 basis points, or is it going to be more like 10 odd basis points?
See, I think it will be in line. So we had guided 3.5%. So 3.5 is the threshold. And with this mix change and with reduction in cost of funds and all, obviously, we'll be able to maintain this for next 2 to 3 quarters. There could be few ups and downs, few bips. After that, it will start inching up.
Got it, Girish. Thank you. This is very helpful, and all the best.
Thank you.
Thank you. The next question is from the line of Sameer Bhise from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on a good quarter. Just wanted to understand on the affordable bit. So we've hit 160 branches right now. What is the plan there, or do you think that we have expanded meaningfully in last 1 year, so you would want to take it slow at this point in time?
So we have 160 branches on affordable side. This year we'll open 40 more branches. So by this year end, we will have 200 branches on affordable side. And this will be the plan for next few years. So we'll keep opening about 40 to 50 branches every year, at least for next 3 years.
Sure. And any specific states, or it remains equally split between north, west, south?
I think we are a national player, so we would be focusing on predominantly 3 zones. South, west and north. We are scarcely present in east, more on the prime side. So our expansion would be in south, north and west. Largely our branch expansion is going to be on affordable and emerging side.
Sure. And just quickly on the stage 3 ECL change sequential, what could be the reason?
So on stage 3 ECLs, one is since we have resolved corporate, so that has completely gone nil. And on the retail side, there is a marginal drop. It was around 35%. It is now 32.5%. This is on account of certain one-offs that we had taken on the retail side, and which were vintage accounts, so which got resolved, or we have taken a one-off where we had a higher provision. So that got released, and the new which got added, the requirement is on a lower side. So hence it is more of a mix change which is happening there.
Okay. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Omkar, an individual investor. Please go ahead.
Hello. Thank you for the opportunity. My question was with respect to the branch itself. Now you said that we'll be adding 40 more branches in the current year and approximately 40 to 50 over the next 3 to 4 years. So can you please help me understand what will be the metrics with respect to the branch? How much time will the branch take to gestate and become a profitable branch, and what are the number of employees per branch and etc. with respect to understanding how the branch will grow as it seasons?
So the plan is to open 50 branches. So this year we'll open 50, and every year we'll open 50 for next 3 years. That is the plan. So this year 50, next year 50, and next year 50. That is the plan of branch expansion. In terms of break-even on the affordable and emerging, both sides, it will take about average about 9 to 10 months time to break even.
Okay, 9 to 10 months. And with respect to the technology transformation that you mentioned in the opening comments and also in the PPT, there is a mention of the reduction in TAT. So what was the TAT earlier and what is it now? Can that be quantified?
Yes. So loan processing TAT, if you are talking specifically to LOS, loan processing TAT is reduced by about 16 to 17%. And on the CRM side, the customer service request is seeing reduction in TAT because we have introduced self-service capabilities almost 18% of requests by the customers are getting self-service without being assigned to any agent. That is improving the tag on an overall basis.
Okay. Can we quantify the tag in number of days? So like how much days does it take from login to sanction or disbursement with respect to days of file that has been reduced?
See, wing to wing, right from reference login to sanction, and including salaried and self-employed, this is decision around 3 working days. So that is we have seen this coming down to close to 4 working days to, gradually we are reducing it to 3. And wherein salaried is decisions in the second day itself.
Understood. And with respect to the cost to income and the OPEX to AUM, as we are saying that we are going to be so aggressive on the branch expansion, affordable housing space, as of what I have seen, they are very the OPEX ratios are very high. So how do we manage to overcome that, and that would not make a drag on the profitability? Could you please share some light on that?
So see, actually on the OPEX side, most of the investments related to 160 odd branches now and 300 overall that we have for the business, investments are already done, right? So it's more upfronted. So whatever you see now would be the run rate. The rest would be in the BAU core that we would be adding. And it will be only the direct cost that we would be investing, which is mostly, in terms of sales and underwriting people. Rest, everything would be the shared infra. And plus the economies of scale will kick in from other businesses, which will help in absorbing. So we are pretty much confident that, 1% kind of a OPEX to AT we should be able to maintain.
Understood. Finally, with respect to the credit underwriting, since our overall portfolio mix is more tilted towards the salaried people and affordable in the tier 3, tier 4 and beyond will be more self-employed. So how are we changing our underwriting practices, and what will be the way that we make sure that the asset quality remains stable? Can you please share that?
So I think the underwriting model for prime and emerging is similar. It is very little different between prime and emerging. I think broadly it is similar. When it comes to affordable, it is totally different. So we have a different vertical for these 3 businesses. We have a different vertical for prime, different vertical for emerging, different vertical for affordable. Now on the affordable side, largely we are going to focus on both income and assessment-based product. It will be 50-50 almost. So 50% is going to be assessment both on salaried and self-employed, and therefore there the underwriting model what is required is very different. So we have a different structure, different team, different head to drive this piece vis-a-vis compared to prime and emerging. On the prime and emerging, it is rule-based and largely the focus is on income side. On the affordable, it is 50-50, and therefore it is more of assessment model. So on the salaried side, when we say informal, it is cash salaried. On the self-employed side, when we say informal, it is basically LIP and certain programs where the income is not there. So there we have developed models. We have developed various templates. For example, we have close to 35 templates depending on the sector, depending on the nature of business. All these are templatized. All these are automated, and this would support us in terms of standardization of the assessment. Having said that, on the affordable side, it's more of touch and feel. So every branch, we have a credit manager. Say credit manager meets the customer, does a personal discussion, assesses the income, and then we use those templates to standardize our decisioning process. So it's very different. On the prime and emerging, it is different. It is more driven by rule-based algo. On the affordable side, it is a mix of both personal touch, personal discussion, and use of templates.
Understood. Thank you. Just one last bit. I wanted to understand what would be the ROA guidance for the next 2 to 3 years.
ROA guidance we are not giving on a annual basis. What we have laid out on our investor day is that we are working towards a range of 2.4 to 2.6% in next 3 years. So we are committed to deliver that.
2.2 to 2.3. Did I get it right?
2.4 to 2.6%.
2.4 to 2.6. Thank you very much.
Thank you. The next question is from the line of Viral Shah from IIFL Capital. Please go ahead.
Yeah, hi. Thank you for giving me again the opportunity to come back. One last question is, so in this quarter you have had 80 crores of recovery, and then there was around 4.5 crores of reversal of provisions on the corporate loans, right? And with an overall net write back of 12 crores, it means that the adjusted or X of the recoveries, the credit cost would have been 72 crores. Would that be a right understanding?
Yeah, that's right, Viral, but that also includes some one-off that we have taken on the retail side. So it is not a core credit cost. That also had certain one-off that we have taken.
Okay. So, and when you mention one-off, as in a charge to the
Yeah.
P&L, right?
Yeah, right. Charge
Okay,
to
got it. Yeah, that makes sense, because otherwise the implied credit costs were a bit higher. Got it.
Yeah. Right.
Thank you.
Thank you. As there are no further questions from the participants, I would now like to hand the conference over to the management for the closing comments.
Thank you everyone for joining us on the call. If you have any questions unanswered, please feel free to get in touch with Investor Relations. The transcript of this call will be uploaded on our website as well as the audio of the call. Thank you.
On behalf of PNB Housing Finance Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.